What are adjusting entries? Adjusting entries are journal entries recorded at the end of the month, are important to provide accurate reporting, can be categorized to two types: deferrals and accruals. Deferrals are adjusting entries that require existing account balances to be updated for accuracy. Example, supplies used up, which is a deferred expense. Let's assume supplies had a balance of $1,000 at the beginning of the accounting period. That's an existing account balance. At the end of the accounting period, there was $200 left over. Here's where you put the adjustment on the credit side to decrease the amount of supplies to $200. Our journal entry is a credit to supplies and a debit to supplies expense. Because we debited supplies expense, this is considered a deferred expense. Let's do another deferral example. In this case, prepaid insurance expired, which is a deferred expense. Prepaid insurance has a balance of $1,200 and existing account balance at the beginning of the period. At the end of the period, the ending balance is for $1,100. This is where you put the adjustment at the credit side for $100. Our journal entry is a credit to prepaid insurance and a debit to insurance expense. Because we're debiting insurance expense, it is a deferred expense. Our next deferral example is depreciation of fixed assets, which is a deferred expense. Let's assume that equipment had a balance of $80,000. That's an existing account balance. With fixed assets, we're going to record adjusting entries under a contra asset called accumulated depreciation on the credit side. In this example, it's credited for $7,000. So we'll have a credit to accumulated depreciation and a debit to depreciation expense. This is considered a deferred expense. Our last example deals with deferred revenues, where there was a customer prepayment and later goods or services were provided. The $3,000 under unearned revenue represents the prepayment and is the existing account balance. When services or goods are finally provided with a debit adjustment, what is owed goes down. In this case, $3,000 worth of services were provided. Our adjusting entry, debit to unearned revenue and credit to fees earned or sales. Because you credited sales, it is considered a deferred revenue. The next type of adjustments are accruals, which are adjusting entries that consider transactions that have occurred but have yet to be recorded at the end of the month. Example, interest owed, which is an accrued expense. The account affected is interest payable. Notice that there is no existing account balance to be adjusted. The adjustment will be on the credit side of interest payable. Let's assume it is for $150. Your journal entry, credit interest payable and debit interest expense. Because this debits interest expense, it's considered an accrued expense. Our next accrual example deals with wages owed, which is considered an accrued expense. This will involve the account wages payable. Notice that there's no existing account balance to be adjusted. The adjusting entry is a credit to wages payable. Let's assume it is for $20,000. Your adjusting entry will be a credit to wages payable and a debit to wage expense. Because wage expense is debited, it is considered an accrued expense. Our last example of an accrual is an accrued revenue example, where previously provided services or goods will now be billed. This will deal with the accounts receivable account. Notice that there is no existing account balance to be adjusted relating to the previous sale. The adjusting entry will be on the debit side. Let's say $7,000. Adjusting entry, debit to accounts receivable and credit to fees earned or sales. Because there is a credit to fees earned or sales, it is considered accrued revenue. Here is an overview of adjusting entries. The arrow represents the accounting period. On the bottom is deferrals. These are examples, and these are the types of deferrals. On the top are accruals. Here are examples, and these are the type of accruals.